So in today's question, we're going to be looking at specifically how property partner choose its properties. Obviously, that's going to be key to any potential opportunities you're looking at. So how does your team and yourself, Rob, I suppose, sniff out a potential opportunity when it comes to
Yes, it's well, you've got to look at the market and where we operate. The residential market is the largest market in the UK of all the assets.
Yeah.
For 4.7 trillion, or it might be a bit out of date, might be 5 trillion now.
Yeah.
It's absolutely massive.
Commercial
Property market is close to $1 trillion,
Yeah.
and that's looking at all the shopping centres, all the offices, high street shops, industrial estates. Add that all together, that's only just under $1 trillion. So the residential market is much bigger. But that's the owner-occupied market. We're actually operating in a very tiny part of that, which is what I call the investment market,
Yeah.
which is let blocks, income producing, which I can buy at a discount as for the whole, and it's a tiny segment. So I don't get a lot of choice.
Yeah.
And so what I'm doing is monitoring the entire market of that. We have some what we call scrapers where we can look at portals. We look for keywords like income, yield, investor, and that pulls them out automatically for us. So we look at those. But generally, the bulk of our stock comes from our market knowledge. We know the main agents, having been at Allsops and Savills, Knight Frank. I'm known to the market.
And they've got a good feel as to what you want.
Absolutely.
And, what you're.
Well, they know that if I make a decision, I'll follow it through. You've got to have that track record. And also we have what I call runners or introducers who know their own patch really well, know everything that moves, and people are maybe thinking about selling, haven't made the decision and say, right, well, let me talk to these and connect you. So a lot of the stuff, we did this, the fort we got on the Isle of Wight came through a local introducer who was born and raised on the Isle of Wight. So that's how these things come about. It did go on the main market eventually, but we had a big head start. It's a very difficult property to get to understand. We had the time to do that because we got the head start. So the bulk of it comes from that, and then on the other hand, you have research saying where the good markets are.
Yeah.
I don't look at that because if I got a slower market, that just means I want a deeper discount.
Yeah.
I want a higher yield. So my pricing in the investment world levels out the nuances of where it's growth. Because if a market's racing away, they're not going to sell to me for a big discount.
Sure.
So it levels it all out. So I know if it's a weaker market, I've got to drive a harder bargain.
Yeah.
A stronger market, I won't get such a good bargain. And so I have access to the entire marketplace, and I'm going to decide what to do and how I operate.
It's the metrics at that time that make it interesting, because you touched on discount a few times, so that sounds like it's a core part of what you do.
Oh, very much so. Yes.
Yield and value.
Yeah. And it's a typical where a rule of thumb. A year or 2 years ago, a typical discount would have been 10 to 15% from the individual sale prices of all the flats or houses.
Yeah.
Now I'd be looking at 15 to 20. That's to compensate me for my lower level of growth I'm going to be receiving, and it gets me a higher income, or a higher level return. And it's a balance between what I can get and where vendors are, because they still might be thinking that, a year ago I could have got this price, and it will take them time. And we've seen blocks coming back to us 6 months later. At the same price, and said, well, no, we know what it's not worth now. That's our standard cry. We know what it's not worth, and then that's the starting point. And then what is it? What is it really worth? And so these are the.
And there's a lot of work that goes behind that, isn't it? It's not straightforward. Like a lot of investors certainly would. I'm sure every investor would want to buy at a discount, want to buy kind of value, and that's the holy grail. But trying to go out there and do it yourself can take a heck of a lot of time, certainly.
And there are investors who will say who don't really know the market and will pay full VP value, the aggregate vacant possession value. They'll pay that because they don't know what they should be doing. With us, you're getting 30 years. It should be a bit more, but 30 years of specialist knowledge of being in the residential investment market over that time through 2 recessions, having seen it, bought it, sold it, and lastly managed it and ran it and operated it. And my right-hand man, who I've been working with since my days as fund manager and RBS and eventually here, same level of experience. And between us, we know we've got a really good feel in the market. Something the other day, I looked at something very quickly and came up with a value of 14 million. and he just looked at it more depth and came up 14.5 million. And now that's very different from the valuation we had on the table in front of us. So that's
a lot more punching probably
a lot more punching, yes.
Yeah, fantastic. So yeah, a lot of due diligence, a lot of research that goes into the selecting of the properties. Thank you.